Good morning, folks. Thanks for joining us again. My name is Neil. I work here in the SBA's Seattle District Office, and this is another one of our weekly Wednesday webinars where we go over programs here at SBA, including our technical assistance resource partners, programs for small business exporters, for federal contracting, and like today, we also cover on a monthly basis our SBA loan programs. I'll be joined today by my colleague, Janie, in a moment, who's going to present on today's topic. Before we do that, I just wanted to mention a couple of things. One, first of all, both Janie and I are joining you from the SBA's Seattle District Office. The Seattle District of the SBA serves Washington State and Northern Idaho. We have 2 district offices here. We have teammates in Seattle and in Spokane, both together serving our Seattle district. That being said, if you're joining us from somewhere in the country outside of that district, there is also an SBA district office near you. And if you need any help finding where your district office is, get in touch with us. We're happy to help you make that connection. I also wanted to mention that we will be recording this presentation, and you will receive a copy of these presentation slides along with a link to that recording. So everything you see and hear today will be in your hands shortly after the presentation. And lastly, if you have any questions during the presentation, while you won't be able to use your microphone or your video camera, we do want to hear from you. We do want to answer your questions, and we encourage you to utilize the Q&A feature. Press that purple Ask a Question button and go ahead and type your question, and we'll monitor those as we go along, and hopefully have time at the end for additional questions. Worst case, just email us with the content information we're going to share with you at the end, and we'll be happy to work with you one-on-one to answer all of your questions. With that being said, I'm going to hand things over to Janie Sacco. Janie is, like myself, also an outreach and marketing specialist here in the Seattle District. Janie, prior to joining SBA, has been a SBA lender for several decades, so has a lot of experience with small business owners and these SBA programs, and you'll be in good hands with Janie today. So Janie, you're up and you can take it away.
Thank you, Neil, and good morning, everyone. Let's go ahead and go on to the next slide and get this started. We're going to be talking about funding your startup business today, and I'm going to be going over a lot of the basic information about what you need to have prepared. And this slide covers all of the elements that we're going to be talking about today. We're going to be starting with the business plan basics, how to think about that, how you can organize your business, and what documentation you need to bring to the lender as part of that business plan based on the type of legal entity you are doing. And then we're going to cover some of the other underwriting basics that the SBA has related to if you have more than one business, and how do you qualify for an SBA loan versus a regular loan. And then I'm going to cover the 5 C's of credit. These are the things that the lenders look at in conjunction with doing a loan request for you and their needs. And then we're going to walk through the business financial information you're going to need to provide, and your personal financial information, and why really it's important for you to have a good handle on all that data. And then some of the supporting documents that you may need depending on your business type. And then if we have enough time, I have a little bit of addendum information we may be able to cover. So let's go to the next slide, please. And we're going to talk about the business plan. And what I really want you to understand is that when you put together a business plan and you give it to a lender for review, they need to read every page of that plan, okay? And why is that? Well, it's because they want to make sure they have a full, good grasp of what you want to do in your business. And sometimes a 20-page business plan has the same impact as a 100-page one. So don't worry about how big it is, but look at the content and really cover the essence of what you want to convey to your lender about your business and why it's going to be successful. All right. So in the business plan, what you want to cover is an executive summary. That summary really is a recap of what your business is going to do. And whether you're building widgets or you're providing an XYZ service, that's front and center. And then you want to talk about who's going to do that and how you're going to meet your customer in terms of building that customer base. So these are the elements of that business summary. And then you're going to go through and do a general business description. So when you're thinking about that, what I want you to understand is describing your business. This is your opportunity to take, this is what my business does from the executive summary, and really expand out and talk about what products or services you're going to be selling in your community to your client base. And you're going to talk about the elements that come together to really make your business work. So if you need to have a production line, staffing for that, these are all the basic elements of what you're going to talk about in your general business description. So if I were going to do product manufacturing, I would want to talk about, this is the product I'm going to deliver. This is what this product does for the client base. I'm going to have all of this done in-house, or I'm going to have this portion manufactured in-house, this portion contracted out. I have very solid contractors that are going to come in. I've sourced them out, made sure I have more than one available to me to make sure that I can meet my sales needs based on the contracting. So these are the elements of it. In terms of the general business description, you really want to talk about your staff, your management of your staff, if you're going to do all of that personnel management in-house, or if you're going to contract it out. You want to talk about how your financials are going to be developed, and whether you're going to have a bookkeeper in-house or contract those things out outside the business, so that when a lender is reviewing your plan, they have a good grasp of, this is how this business is going to function. And this is how you, as the owner of the business, have developed this opportunity to be successful. All right. When you're talking about your product or service, you really want to hone in and define it in terms of, again, what is this going to do for my client base? All right. You have to have a competitive advantage with either your product or your service, and identifying that competitive advantage over your competition is really key. Okay, so you have a deliverable, you have something you have that you want to sell, and why is that going to be of value for your clients, okay, your customers? The marketing plan should then flesh out a little bit more your client base. And as part of that marketing plan, you want to talk about the elements of what's your demographic? How are you going to reach your demographic? You'd want to put information in that plan, that marketing plan, about really a focus on where did you get your data? Did you use the U.S. Census Bureau? Did you use the public library resources? Where did you gather that to develop your client base? Okay, your marketing plan should really hone in on how you're going to reach your targeted market. And again, how you are going to market differently than your competitors. Or are you going to do the same thing? What is your marketing advantage going to be in terms of attracting those customers into your business. And then your operational plan essentially is dealing with how you're going to manage the day-to-day of your business. And you want to, again, be clear about that information in terms of the operational control and management of the staff, what everybody's responsibilities are, and how your staff works together as a unit to achieve the end goal of meeting your customer needs, either with product or service. The management and organization is really critical for a lender to understand, because they need to know who the key players are and their work history, their certifications, their education, what tools and skills those managers are bringing to make your operation be more efficient and more effective in terms of maximizing the staff that you have and in production line if you happen to be a manufacturer. The organization of it, of the business, really helps the lender understand the total flow of when your process starts to when it ends. Okay, so keeping that concise and easy to read is really a key element here. Again, you're giving overview information at the very beginning, and you're developing it as you go through that business plan. Ownership is really critical, because with financial institutions, when you're looking at their underwriting, if someone has a certain level of ownership percentage, that may trigger that individual to be a personal guarantor. When you're looking at the SBA programs, any person or legal entity that has 20% or more ownership of the business is required to guarantee the loan. There are no exceptions to that. So understanding by the lender of who the owners are really helps them define what other information they may want to have from you if it is not in the material that you're already providing. We're going to go over more of the financial information as we go through this in terms of what is really needed. But basically, for a new business, you're creating cash flow projections, and you're creating an assumption-based projection document that tells the lender how all of the other stuff that you have put together in your plan, your product, your service, your marketing plan, how you're going to put all of your operational elements together. Your financial information in that cash flow projection should be the numeric summary of what you've been telling the lender all along in your plan. And then technical information. If it's needed and important and relevant for your new business, for the lender to understand some really technical elements about what you do, then please put that in there. An example is you may need to meet certain specifications for ecology, the Department of Ecology, when you're out doing your environmental cleanup, okay, business. And so you want to demonstrate that you, from a technological standpoint, have the ability with what you're putting together to meet those criteria and those standards. So again, sometimes technical information is really very valuable to the process. Next slide, please. And Neil is going to interrupt me at any point in time if you have a question. So you go ahead and you ask those questions, and we'll get them answered right away. All right. When you're looking at the business legal documents, this is really a key issue here. If you are a sub S or a C corporation, you should have developed articles of incorporation. The state of Washington only requires the articles of incorporation to be provided when you're going through the legalization process of getting your business set up. But the lenders want to see the bylaws, because the bylaws tell them Who is responsible for pledging collateral on behalf of the business? Who is authorized to sign on behalf of the business to indebt the company? Meaning who can borrow. And so it also tells how many people are required to sign loan documents to indebt the company and pledge collateral. So these are really important aspects of your organization that are not necessarily covered in the articles of incorporation. So your lenders will ask you for both documents. When you get your legal entity registered with the state of Washington, the state will offer you, the Secretary of State will issue you a certificate of incorporation document. The Department of Revenue issues a business license, okay? Other things that you may need to provide are meeting minutes if you've had any changes in the ownership of your sub S or C corporation. You want to make sure that all of your information is consistent for your public records. That includes going to the Secretary of State website, the Department of Revenue website, and your company's website. And lenders check all that information to make sure that there's consistency of the data, all right? So I've given you the links here to the Secretary of State and the Department of Revenue, so you can check and make sure that information like the legal entity name, the trade names, the owners of the business are all consistent. And other things that report here on these two websites are the business's location address, the physical address, and then the mailing address. So you want to make sure all of that information is consistent. And again, same thing with your website. Next slide, please. For a limited liability company, what you are looking at for organization documents is articles of formation and an operating agreement. The articles of formation are very similar to the articles of incorporation, only it's a limited liability company, so they changed the wording a little bit, right? The operating agreement functions just like those bylaws documents. The operating agreement tells the lender all about who is authorized to do things on behalf of your company. The Secretary of State will issue a certificate of formation for your limited liability company, and the Department of Revenue will do the business license. So again, with the meeting minutes, if there's been any changes in the ownership and or responsibilities and duties, authorities, you want to include that information in there as well over time. Again, Secretary of State, Department of Revenue, and your website, all that information needs to be consistent, just like with a corporate document. Next slide, please. If you want to do a sole proprietorship, you absolutely can. What you need to have is a business license, and you would go through that process with the Department of Revenue. And again, make sure your information that you have with the Department of Revenue is consistent on your website. So addresses, all of that. All right. The sole proprietorship is the easiest company or organization to get started in terms of just your paperwork. All right. Next slide, please. All right. Now we're going to talk a little bit here about the way the SBA treats affiliation and credit elsewhere. Why is this important? Well, there was a change not that long ago in terms of how the SBA defines affiliation. And you know, the really nice thing about this is that it eliminated, it basically eliminated a lot of limitations that were assigned to affiliation. So now when a lender is reviewing your plan, what they're going to do is they're going to ask you if you own another business. if you do own another business, they're going to ask you what industry it's in based on the first 3 digits of your North American Industry Code System number, or your NAICS code, okay? And they're going to talk to you about how much you own of your other business, okay? So what they're looking at here is really the ownership percentage and the affiliation as it relates to being in the same industry based on the first 3 digits of your NAICS code. In the past, the SBA treated franchises a little bit differently in terms of underwriting requirements, and they no longer, we no longer do that. So it just, as everything evolves, the SBA programs keep getting updated to make it easier for you to have access to funding and get rid of limitations. So that's what we've got for going on for affiliation. Next slide, please. All right, so this is really dry, okay, dry reading, but I do always have to kind of focus on what do our standard operating procedures say, okay, and our most recent one that's been issued is the 5010 7.1. That's the document that the lenders underwrite our SBA guarantees to, okay. So when you come in and you're talking with a lender, they're going to ask whoever is the more than 50% owner of the borrowing business, the applicant business, if they own another business. And then they're going to look at that 3-digit NAICS code, North American Industry Code System number. If no one owns more than 50% of the borrowing or applicant business, then it drops down to the 20% or more owners, and they go through that same process. So what happens if you have more than one company and you are the majority owner and you have a business that another business that's in the same industry, same 3-digit NAICS code? Then the lender is going to ask for the financial information for that related entity, okay? And they're going to look at spousal ownership and minority children ownership in those related companies. So this is part of the process. So when the lenders are asking you these questions, don't be intimidated by them. Just be able to understand this is part of their underwriting that they have to do a review on when they're looking at doing a loan for anyone who they may need to do an SBA guarantee on the loan. All right, next slide, please. The other thing that the lenders are required to do is what we call a credit elsewhere test. So what that means, quite simply, is that they need to underwrite and review your application based on their lending policies, okay? And if you do not meet their criteria, then they have the ability to look at doing an SBA guarantee on the loan that you're requesting from them and participating in our program. So I'm going to stop right here because I keep saying the guarantee. Here's the deal. What happens is if you have a $100,000 loan request, for example, and you're going into a lender and they feel like because you're a startup business, it's too much risk for them to take on, or they have a loan policy where they do not loan to startup businesses. However, they will in conjunction with the SBA program. So this gives them an opportunity to review your request based on their normal underwriting criteria. And if you don't meet it, then they can come and look at our standard operating procedures, that SOP, for underwriting your loan. And it gives them the ability to expand their capability of providing funding in their community. That is really the key. The guarantee that the SBA offers to the lender helps reduce their risk or perceived risk of doing this loan to your startup business or any type of application that they're working on. And the SBA extends a particular percentage guarantee to the lender on the loan, and it impacts the outstanding balance over the life of the loan as the loan is paid down. All right. So our guarantee percentages run anywhere from 50 to 75 to 85 to 90%, depending on our program that the lender is utilizing to help do funding to you they would not otherwise do. All right. So the bottom line here is that when the lender is reviewing your application, they're going to review it to see what the risk factors are on your transaction. We're going to talk about those in a little bit in these slides, but the risk factors have to do with cash flow and your ability to repay. There are also risk factors related to the amount of your equity injection, the amount of collateral being pledged to secure the loan, and also your credit history. What happens is if you have higher risk factors in any one or more of those 4 categories I just talked about, that is an ideal situation for the lender to utilize our programs to help mitigate the risk. Okay, so going back to that $100,000 example, if a lender was doing the loan for $100,000 for you on their own, that would potentially be a $100,000 loss for the lender. However, if they do that same loan with an SBA guarantee, they would have an 85% guarantee on that loan amount. Their exposure or loan loss risk is now dropping down to 15% of the loan amount, or $15,000. So this demonstrates the level of exposure or risk drops significantly when the lenders use the SBA programs. And that's what motivates them to do these loans to help, again, expand your ability to get funding in the community for their businesses. All right. One of the things that has changed fairly recently as part of our updates to the program is that the lenders no longer have to look at your personal assets, your liquidity, to make a determination on whether or not you're eligible. That's a big deal. That allows you to retain your cash reserves personally, rather than having to inject them into the business entirely and giving up liquidity in those reserves in case something happens personally for you or in the business where you want to take that cash and use it according to what your needs are. All right. So these are very important things. The SBA does have size standard requirements. If you have a business that the NAICS code requirement is based on up to a 5-year average annual revenue, that may be one standard. The other standard is a maximum number of employees. And the SBA table of size standard link here is an indicator of, based on your NAICS code, what your size standard is, and the lenders want to make sure that you're within that. For those of you who are startups, you're not going to have a problem because your average annual revenue for the last 5 years is 0 for your business. So that's not a problem. And in most cases, your employee numbers are going to be well within those standards as you're just starting out. Okay. So I would assume that you wouldn't have a lot of risk factors there. Next slide, please. So now what we're going to transition here to is the 5 C's of credit. These are the risk factors that when a lender is reviewing your business plan, they're going to be looking at. Okay, so you definitely want to include all of this information in your plan as you're giving it to your lender. The 5 C's are capacity, cash flow, your capital contribution, the collateral, and the character, which I mentioned those prior. Next slide, please. We're going to delve a little bit deeper into each one of these 5 C's so you have a good idea of what to put in that business plan and why you're putting it in there. Let's talk about capacity for a moment. Really, this boils down to who are the key players in your business. You definitely, as an owner, are a key player. Any other owners are key individuals. For the owners in the company, you definitely need to have what I call a muscle-bound resume, okay? I want you to talk not only about what your work history is, but the skills that you developed in each one of those jobs that becomes transferable over to your business success, okay? And future success down the road. You want to talk about your skills that you garnered in each of the positions that then becomes ingrained in you and transferable to your management of your business. Things like managing people, putting cash flow projections together, putting budgets together, managing a production line if that's the case for your business, understanding how to look at financial statements, a balance sheet, an income statement. What do those documents tell you? How do you manage them? Focus on the critical aspects of what you did really well in your work history and how you helped your employer become more successful. This is your opportunity to really talk about all of your great skills, okay? So when you're putting that resume together, don't just put, I worked at XYZ company from this period to this period, and these were my job responsibilities. Focus on expanding that, as I just said, and really key in on what you learned and what you learned to do better, all right? If your business requires certification or certain education levels, okay, then you may need to include those certificates in that plan. You might want to talk about your education. Certainly, if you are an attorney, you want to talk about your law degree, maybe where you went to school, what that did to help you do your job better. Okay, so those are just some examples. If you are in a trades type of business and you had a journeyman or woman period of time that you were learning your craft, you want to talk about that as well. All right. So again, work history, certifications, education are all key components for the owners of the business. And then if you have key individual employees that you're hiring, you may want to do the same thing for them. Again, what you're trying to do here at a high level is talk about the skill bases of the individuals who are going to be the key components in operating the business and making it be successful. Okay, maybe your sales team, maybe your creative team, your R&D staff, creating new product or service. All right. If you have, an advisory board or a board of directors, you want to talk about them and their contributions, what they're going to bring to the table to give you guidance long-term, help you through the startup phase and beyond, and how to expand your business down the road and what your plans are in the immediate, the short term and long term. All right. And then if there are some weaknesses or gaps in the skill base of your ownership team and some of the key personnel, you want to also talk about how you're going to contract out for services that really are needed in your company. If you don't want to hire an attorney, but your business is based on contracts, you definitely want to have an attorney that can help you develop the contracts successfully to limit your risk on your work that you're doing for your client base. So you'd want to talk about who you're going to have for a legal firm. Same thing with bookkeeping services. If you don't want to hire someone on staff, you can contract that out. And then someone to do your tax reporting. And so you want to talk about why you selected these particular providers of the service to help you. That's all about capacity. It's talking about how you're going to fulfill your business goals and missions with the people who you have as on part of your team, including you. Next slide, please.
Danny, I just want to mention we have
Yes.
no questions at the moment, no open questions, but we also did just pass the halfway point
Okay.
of the timing. So just keep that in mind.
Sure. Thank you. Okay, so now what I do want to mention here is that with capacity, that cannot be mitigated by the SBA guarantee. You have to have that skill base, okay? Now we're going to talk about the aspects of the 5 C's that may be mitigated, all right? And if you're a startup business, again, I mentioned this, you need to put together, excuse me, a cash flow projection for the first 2 years of your business. The really key here is it's not just those numbers, but more importantly, the assumptions that you're making about them. And again, think about that marketing plan. This is where your revenue stream, your revenue numbers meld with that revenue or that marketing plan. You have to be able to demonstrate how you're going to be getting your revenue in on a monthly basis, okay? And most importantly, is it cash in on that month? Or are you collecting on accounts receivable that you build your client base in the future, all right? You want to talk about if you're doing, again, accounts receivable billing to your client base, you want to talk about the terms you're giving them and the expectation when you're going to be collecting that money. Your cash flow projection document helps you define when the cash is actually coming into your business rather than when it is billed, okay? This cash flow projection document allows you to talk about cost of goods sold, who your vendors are, what terms they're going to give you, and then it also demonstrates your operating expenses, your fixed costs for your business. Things that are repetitive consistently from month to month to month, like payroll, like rent, like updating, if need be, your website and paying for those update costs. Any other marketing that you're doing, okay? So you have, if you're getting a loan, then you're going to have interest expense. You're going to have principal payments. You're going to be paying yourself, okay? If you're a business that is based with vehicles, you're going to have maintenance and repair of those vehicles. You may have maintenance or repair of your facility. So again, you want to take a look at your expense stream and make sure that you're allocating it properly based on the month. Oh, and did I mention taxes? B&O taxes have to be paid in the Department of Revenue. You may have Labor and Industries and Employment Security Department payments that you need to make, and you need to make those timely as much as possible to avoid penalties. So this cash flow projection document will help you identify when you have to make those payments, and more importantly, how you make them, okay? So you want to talk about here your customers and how many you need to have in, how much you're going to be charging them, whether product or service. Again, focus on detailing logically how you are going to bring those numbers in and make your payments and where you're going to have enough money to make those payments every month, okay? And sometimes if you're getting a loan, you're building in a working capital reserve. And typically you want to do that for at least a 3-month period of time for your operating expenses so that you don't run out of cash. But this cash flow projection document, because of the way it's laid out, you will know if you have any months during the first 12 months, if there's a negative position, and you want to have a cash reserve, at least for that amount and a little bit more just in case you're off a little bit, okay? Your customers are key. You want to be able, again, that competitive advantage, how you're bringing them in, what you're offering better than any of your competitors is really a key component here. And the other thing I do want to mention relative to your competition is you do need to define who your competitors are. You want to talk about them as your primary competitors, your secondary competitors, and your third or tertiary level competitors. So think of McDonald's, Burger King as a prime competitor, a Subway shop, maybe a secondary, and then the deli in a grocery store may be a tertiary type of competitor. All right. So flesh that out. Make sure you understand in your area and for your client base, whatever market area you're defining, that you understand who you're competing against realistically. Okay. That's going to help the lender understand the rationale behind that cash flow projection. And I've included a link to a sample cash flow projection from our wonderful technical assistance provider, SCORE, the Service Corps Retired Executives. Next slide, please. For existing businesses, as you grow and expand and you're looking for additional funding, your lenders are going to look at your historical cash flow. They're going to ask you for tax return information. They're going to ask for profit and loss statements, also called income statements. Just depends who's prepared them as to their title. Okay. If you're going to go out and buy a business, you're going to be asking the seller for up to 3 years of business tax returns. You may need to have them prepare a company prepared balance sheet and income statement for the most recent year if they have not filed their tax returns yet for it. Okay. If you're buying a business and a seller is carrying a note payable, then the lender will analyze all of that debt as part of your repayment responsibility. So there are very specific rules related to repaying that seller, and they do have to wait for principal reduction on their loan. If a lender is doing a loan in conjunction with an SBA product, the seller has to wait for a 24-month period of time for principal reduction on their loan. They are allowed to get interest-only payments during that first 24-month period of time. Next slide, please. Okay, with your capital or your contribution, the SBA, for the most part, allows the lenders to provide up to 90% financing on your project cost. Okay, so they look at the entire need of doing your business. Your minimum requirement in most cases is at least 10%. Okay, and the lender can finance up to 90%. We do leave that investment or capital contribution, your injection, all the same thing. Okay, just different words to describe the same thing. We allow the lenders to make that determination based on their underwriting criteria. Okay, so for new businesses, startups, the lenders can request anywhere from 10 to 20, 25, up to 35% of your funds to be injected based on your total project. So if you have a $100,000 total project need, the lender may come in and say, you need to bring in $35,000. We will lend up to $65,000. Some lenders will say, we'll allow you to put in $10,000 and we'll lend up to $90,000 in that total $100,000 project. This is competition. And that's why you should talk to more than one lender when you're out there sourcing funding, even if they are an SBA lender, because again, we allow them to use their own underwriting and risk assessment levels based on their institution. And because there's competition, they have different underwriting criteria. Okay. And that includes this capital contribution requirement. So where would you get the money from? Well, normally we're hoping it would probably come from your personal savings, but you can have family members or friends gift you money. If it's a gift, that is treated as if it is just part of your equity contribution, no strings attached. Your friends and family members can lend you money, all right? You can borrow against personal assets like your home equity line of credit. You can take an advance on that and inject that money into your business as part of your ownership contribution, okay? Sometimes people have stocks and bonds. Another source that can be used is if you have a retirement plan. You do have to set up a C corporation because a C corporation has a 401k plan. You can transfer the funds over without penalty, without having to pay taxes on it. That is always an opportunity. The other thing I do want to say is you can get a note payable from a seller or, again, another investor. The lender will ask anybody who is lending you money to sign what we call a debt subordination agreement. And it really, that debt subordination agreement makes everybody understand that the lender gets paid first, and then everybody else has to wait for repayment. So family members, friends, sellers, other investors, they will be asked typically to sign this debt subordination agreement, putting them in a second position for repayment, okay? And that will be for the life of the loan and can be implemented at any time. So when you're doing those debt subordination agreements, you want to make sure with the lender when you can start making the payments to the people who have lent you money, okay? And again, the seller financing is a little bit different issue. There is a mandatory limitation on that for that 24-month period of time that may not exist for the family members, friends, or other investors. All right. Next slide, please. All right. Collateral is a really big deal because what the lenders look at is what we call liquidation value or fire sale value. So if you're getting a loan and that loan is to go out and buy $100,000 in brand new equipment for your business, the liquidation value of that collateral is 75%, or it's worth $75,000 as pledged against the loan. Okay, so there's a liquidation schedule for all the types of assets depending on the type of loan product you're doing. Okay, accounts receivable, inventory, furniture, fixtures, equipment, leasehold improvements, they all have a different liquidation value percentage. All right, and if you're doing a line of credit with an SBA guarantee or a term loan, those liquidation percentages can vary. So you want to work with your lender, talk to them. A lot of times, especially with a startup business, you may not have enough liquidation value collateral to what we call fully secure the loan. In other words, the liquidated value of those assets is less than the loan amount. That's called a collateral deficiency. Okay, the SBA does not deny a guarantee simply because of lack of collateral. What your lender should be doing is talking to you about what other assets you can pledge. Typically, to support that, it's generally things like the assignment of a life insurance policy or the assignment of a disability policy. And if the lender is requiring either of those, it becomes a business expense rather than a personal expense for you. Okay, so collateral gives you the most flexibility. And what I want you to know is that if your loan amount is $50,000 or less, $50,000 or less, the SBA does not require the lenders to take collateral. In many cases, though, I will say the lenders will ask you to do that because they're underwriting to reduce their risk. All right, so we've got flexibility and it's really at the discretion of the lender. Next slide, please. Okay, the last component that the SBA really helps you as a borrower on is this element of what we call the character analysis or your credit history. Okay, so you're a startup business. What the lenders are going to rely on is your personal credit history. For each 20% or more owner, signing your application for the loan gives a lender the right to pull your credit report history, okay? Some lenders pull a credit report on all 3 reporting agencies, Equifax, Experian, and TransUnion. Some of them only pull on one. So my recommendation to you, before you sign on the dotted line, and actually even before you apply and you're putting your business plan together, I would encourage you to do is to go out to each of the credit reporting agencies for each 20% or more owner and get a free copy of the credit report on you to review and make sure everything is correct and in the best light possible, okay? So if you have something that you didn't know about, that may be a medical collection or a parking ticket collection or something like that, you get it taken care of. You keep the documentation evidencing that it's been corrected, and you provide that whole scenario in as part of your business plan, okay? And what it does is it gives the lenders the opportunity to review your credit history and look at it and talk to you about it before they actually do a hard pull on their own. Hard pulls will take your credit score down. And if you do 2 or 3 or 4 in a short period of time, it takes your score down more and faster, okay? So we want to not have that happen. When you request a copy of your credit report, that is what is called a soft inquiry, and it does not impact your credit score whatsoever, okay? So the lenders are going to be looking at how you paid your personal debt obligations. They're going to be looking at if there's any bankruptcies, any collections, any garnishments, things like that that are outstanding that haven't been dealt with. And if they want to pursue doing the loan, then they will ask you to get all those things cleaned up and document them prior to giving you the loan. But again, do that ahead of time and put your best foot forward on that, all right? When you had a bankruptcy, most lenders want you out of the bankruptcy by about a 5-year period of time. They want to understand why the bankruptcy occurred, why there's potentially bad credit there, even if it wasn't a bankruptcy. So what I would encourage you to do is talk about that, provide a little bit of a history. Maybe you had a job loss or a marital dissolution or a catastrophic medical situation, and it created a very challenging time for you and inability to repay your bills. And then you worked your way out of that. So you want to talk about what's happened, okay? You want to talk about the reasons for the bankruptcy. Criminal history has really been changed in terms of the questions that are being asked. That form here, the SBA form 1919, I want you to understand that this form is based on the business borrower and then all the owners. So you only have one form that you need to do, and whoever is completing it is doing the form based on all of the owners in the company, okay? So you want to make sure you have a really good idea of how to answer those questions correctly. And there is now only one question regarding criminal history. In the past, there's been 3 or 4, and it made people feel like, you know, they weren't eligible, but you may be, even if you're answering yes. You just need to explain what transpired, okay, and provide a little bit of supporting information. So next slide, please. So what I want to just kind of sum up here is that when you're looking at those 5 C's, capacity, that's on you. You have to do that and be able to operate this business successfully. Where the SBA can help you and help you get funding from a lender by utilizing our programs is on those cash flow projections, on your capital injection being a little bit less than what the lenders would normally require, having a lack of collateral, not such a big deal. And then your credit history, if your score is a little bit low, but you're cleaning it up, that'll help you, okay? And the SBA guarantee will help mitigate some of those risks, all right? For a startup business, in terms of the documentation you'll need to provide on the balance sheet and the income statement, the cash flow projection, these are the 3 documents you should do. That pro forma balance sheet shows the lender all of the assets that you're going to need to keep your business going, okay? Whether it's inventory, furniture, fixtures, equipment, leasehold improvements, vehicles, whatever, it's all going to be on there. And that, when you get to the total of the assets, that's also known as your total capitalization requirement. So don't be thrown by these words, okay? It's just your total assets needed to start your business, all right? And then they're going to be looking at your equity contribution and who you're getting funding from them as a lender. You're requesting that if you're going to carry any other notes payable that we talked about in the past. If you will be generating accounts receivable, you definitely would want to do a pro forma income statement. And then you want to do the cash flow projection document that we talked about in the past. Next slide, please. Okay, let's talk about the balance sheet. All right, 3 components. Assets are on the left, liabilities and owner equity are on the right. And the bottom line is that total assets have to equal liabilities plus owner equity. That is what balances your sheet, okay? So again, the total capitalization requirement I just mentioned. Next slide, please. Don't want to be too redundant here. Okay, so again, the lender may require more than that minimum 10% equity injection. It's going to be based on their assessment of those overall 5 C's and your industry experience. And if you're doing a brand new startup business, you really should have a couple years of industry experience. That's what the lenders are looking for, and they're looking for recent industry experience. So again, you have that 9-to-1 debt to equity ratio. That means 90% of the funding is coming from the bank, 10% is coming from you. Okay, and we've talked about your sources of the equity contribution. Next slide, please. Cash flow projection. Next slide, please. Okay, put this in again. All right. I want you to remember when you're putting that cash flow projection together is for every line item that you have on there, you want to put your assumptions. Okay. And again, the key components here are when you're talking about your revenue coming in, your cash coming in, you want to talk about your cash sales, you want to talk about your collection of your accounts receivable, what terms you're giving your clients. Is it net 30, net 60, net 90? And because that anticipates when you're generating your revenue, when your cash will actually come in, okay? Cost of goods sold, focus on your vendors, your pricing, and also when they're going to let you pay. Are they cash on delivery, cash up front, or are they going to give you 30-day terms, 60-day terms, 90-day terms? So these are things you want to talk about. Again, your operating expenses, those are the repetitive things. On that rent, what you can do there to help your lender is get a draft copy of a lease, not a signed lease, the draft copy, so that the lender can see what the landlord is willing to do for you in terms of those lease payments and when you're going to have lease increases in your facility. Next slide, please. Okay, other documentation to support your cash flow projections. The U.S. Census Bureau, information that you can gather from your city, from chambers of commerce, other organizations that are related to your industry, okay? If you are working with a franchise business operation, your franchisor can give you a lot of data to help you based on your market area and the size of the location. And it's really key. The franchisor can give you assistance in terms of putting those revenue numbers together and your expenses. You definitely want to talk about limitations on other franchisees coming into the area. You want to provide your franchise agreement document so that the lender can see what your obligations are for communal advertising and a recurring royalty fee or franchise fee throughout the period. Okay, so the lenders want to make sure you have the capacity to manage those franchisor requirements. Okay, next slide, please. Lenders. Okay, we have banks, credit unions, and small business lending companies that can do loans up to $5 million, okay? With a SBA 504 program, which is a fixed asset acquisition and refinance program. In some cases, the lenders can go up to $5.5 million. We have our community advantage small business lending companies that can do loans up to $500,000. And then we have our micro lenders that are smaller dollar lenders. They can do loans up to $50,000. Next slide, please. All right, for our banks and credit unions in the Seattle district office, I've given you the link to our lender list. There are about 90 lenders or so on there. Nationally, if you want to broaden your scope, you can go to our My SBA portal at lending.sba.gov. Again, your link is here, and you put a little bit of information in about your business and your borrowing needs, your geographic location. And on the other side, we have lenders that are putting information into this system saying this is where they want to lend, the dollar amount ranges, and uses of proceeds. So you get a nice match. After you hit your submit side, you'll get a list of lenders that you reach out to. They're in random order. And the lenders will not be calling you. You have the opportunity to reach out to them. So you're controlling that access to the lender. And again, that's nationwide. Our community advantage small business lenders include the 4 listed here. They lend throughout our district. And as Neil mentioned, that's the majority of the state of Washington and the 10 northern counties in Idaho. They provide technical assistance as part of their funding, and they are what we call our mission-based lenders. They lend to underserved communities, they lend to women, they lend to disadvantaged business enterprises, to veterans, and to startups. So they're a great source for you to go to as a startup business. Next slide, please. Our small business lending companies, this is the updated list. These are non-deposit institutions. They are not banks. Their sole mission is to lend money. And under our programs, they are allowed to lend up to $5 million in aggregate per small business. And they all lend nationally in scope. Next slide, please. We have our micro lenders. I just want to touch base on those a little bit. These lenders really, again, are part of our mission base. They work with the smaller dollar borrowers. They work with startups, woman-owned, veteran-owned, disadvantaged business enterprises, rural market areas, underserved market areas. They all have slightly different missions in terms of their organizations, but they all participate in our program. And one thing I do want to say is that our banks and credit unions, our small business lending companies, and our community advantage lending companies, they structure their loans with an adjustable interest rate pricing. The micro lenders offer you a fixed interest rate loan. So this may be a better loan for you if you have that kind of risk appetite. Next slide, please. Other resources we have that are related to the SBA are our small business investment companies. If you're not product ready or service ready, they may be a good resource for you. And then we do have our competitive grant programs for businesses that do primarily research and development, whether it's a product or technology. Check out our small business investment group and with sbir.gov to learn a little bit more about that type of access to capital. And then for contractors, we have wonderful programs for them. I'm not going to get into in detail. We have our surety bond guarantee program. If you need bonding, it's a great program to look into. Next slide, please. All right, other non-SBA lending sources include our sister agency, the U.S. Department of Agriculture. If you're in a rural market area where the population base is less than 50,000, you might want to check it out and look at some of their programs. The state of Washington Department of Commerce does an outstanding job of offering a variety of funding programs for small businesses in our state. And then Evergreen BizLink is an aggregation of really small micro lenders that are not related to SBA, but they are micro lenders in your community. So you might want to check out evergreenbizlink.com to see if you have a micro lender outside of our micro lenders in your community. Next slide, please. Okay, personal information requirements. We're going to fly through these. I already mentioned it, 20% or more owner. Again, what you need to provide is up to 3 years of personal tax returns. You need to fill out a borrower information form and a personal financial statement. Really focus in. The lender will give you direction on all of these. I wanted you to have the links to everything so that you could go through it and look at your leisure. Again, personal financial statement and up to 3 years of personal tax returns is mandatory, okay? To evidence your capital injection, the lender will ask you for at least 2 months of bank statements or some supporting statement to indicate where that money is coming from, okay? Next slide, please. We have supplemental guarantor capacity on these loans, and that means if you want someone else to come in that is not an owner in the business and be a guarantor on your loan, you're able to do that and help you shore up any weaknesses that may be there as reflected by the lender's analysis. Next slide, please. Supporting documents. Next slide, please. Okay. I've talked about the franchise financing, franchise agreement. You definitely, if you're involved in a franchise, you definitely need that agreement to accompany your business plan. Next slide, please. If you're buying a fixed asset like equipment or real estate or anything like that, you want to have a purchase and sale agreement. At least preliminarily done, or invoices, anything to demonstrate what the value of the asset is that you're purchasing and evidencing that transfer of the asset. Okay, so for titled vehicles, definitely you want to have access to the title when you are buying it. Next slide, please. Okay, for commercial real estate, again, there's a whole process with that. Basically, with our programs, if you are having a business, your operating company, and you're buying commercial real estate, and some of you startups may be doing that, what you do need to have and understand is that if you're buying a piece of commercial property, your business needs to occupy at least 51% of the space, okay? If you have decided to do ground up construction with a project, you need to occupy at least 60% of your space, okay? That's the owner occupancy requirement. And again, purchase and sale agreement has to identify a closing date, and the escrow company for that real estate transaction needs to be in there so everybody knows when they have to meet that closing date at the latest, all right? If you're leasing space, you need to make sure that your lease agreement gives you occupancy rights in your space to up to 10 years, okay? If you want to maximize your ability to borrow on the longest maturity of an SBA loan, all right? And then if, let's see, what else here? If the seller has done any environmental reviews, you want to make sure they give them to you. Your lender, when you're doing a commercial real estate acquisition, what they're going to do is they're going to do an appraisal on that property, and they're going to do an environmental assessment, and that does take time. So you want to make sure you're allocating enough time in this closing process to make sure you can close timely. Next slide, please. We're honing in on the end. So thank you for hanging in there. Okay. Insurance requirements, depending on your transaction. If you have equipment or inventory, you're going to have a general asset replacement policy. You may be asked again for that life insurance or disability policies to be assigned to the lender. If you're pledging your home as part of the collateral, you're going to have to provide a copy of the homeowner's insurance policy. If you're in a flood zone with either your home or the commercial property that you may be buying, you would need to evidence flood insurance. If you are in a medical profession, you may have to have professional practice insurance. There are other types of industries that also require that. And then if you are serving liquor of any type, you do need to have DRAM insurance. So think about all of those things and then make sure you have them available for your lender. Next slide, please. Okay, we're down to the end. If you want to reach out to us, you can give us a call on our Spokane branch office with a number there. Our Seattle district office also has a separate number, or you can pop us an email at info.sto@sba.gov. We try and get back to you the same day, if at all possible. Sometimes it flows into the next day depending on what's happening or what time you may have reached out to us. You can also connect with us at sba.gov/Washington, connect with us on X, or if you want updates on all of our programs, you can sign up for those on sba.gov/updates. Next slide, please. If you have any questions, Neil, are there any questions?
Hey, Janie. We don't have any questions open in the Q&A right now. Folks can always email directly with any follow-up questions, but I think for now we are all set.
Okay, great. So let's just flip through the rest of this really quick. I'm not going to talk about it too much. I do, if you want to give us feedback on the presentation, you can do so. Next slide, please. The addendum information includes ineligible business types. Next slide, please. We'll have 4 slides in here on all of our different SBA programs. So flip through those. And then I finish it up. If you need technical assistance, we have great no-cost providers that are related to or associated with us. SCORE, I mentioned before. Next slide, please. We have the Washington Small Business Development Center and the Idaho Small Business Development Center. And then we have 2 women's centers in Lacey and Seattle. And then for our veterans, we have on the next slide, our Veterans Business Outreach Center. Thank you very much for hanging in there and staying with us today. I hope you got something out of this. And if you have any questions, please reach out to us. Thank you very much. Neil, you want to close us out?
Thanks a lot, Janie, and thanks everyone for joining with us. Just a reminder to get in touch with any questions and keep an eye out later today for the recording and the slides. And we'll see you next time. Thanks again.
Thank you. Bye-bye.